Hi, and welcome to this simple analysis of New Wave Group. So what is New Wave Group? Well, New Wave Group is diversified between two main types, promo and retail. They are split in three different segments, that is kind of like below promo and retail, corporate, sports and leisure, and gifts and home furniture. The corporate stands for slightly over 50% of the sale, but the sport and leisure is now building up to either take over or getting closer to corporate sales. The promo is more or less in the corporate area, but you can also see it a little bit in sports and leisure. Their portfolio contains of famous brands like Kraft, Cutter & Buck, and Click. Their vision is split in three, like I mentioned, corporate, where the main goal is to be one of the leading suppliers for promotional products in Europe and one of the leading suppliers in US, offering a broad product range with strong brands and experience. Sports and leisure, where they put focus points on specific brands like Kraft and try to establish it as a world-leading sportswear brand. Other examples are also Cutter & Buck with golf and Eau Claire with gloves. When it comes to the gift and home furnishing, they want to make Örfors and Kosta Boda the world-leading glass and crystal suppliers, while Sagaform should be one of the main contenders for kitchen and home furnishing in the Northern Europe. So they have a fairly wide span of strategy here. So where are they? Well, globally in Sweden. Their main sales are of course Sweden, which is where they're coming from. They are though based throughout most of the Western world, where their main sales now are growing in Central Europe as an example. And in total, Central Europe, Sweden and USA are the areas to watch out for right now. They also have established sales in China, but sales-wise, USA and Central Europe is, you just can't compare it to China currently. So what is their strategy? Their strategy bases itself on acquiring new companies and products, launching and developing brands over time, and building market share slowly by establishing brands in new geographic markets and using the group's huge network to benefit their smaller acquisitions. So how was the last year for New Wave? So one thing that keeps on being mentioned is how New Wave Group keeps on gaining market share. This in itself is very positive, and is, as in more beneficial markets, the margin and sales will stand stronger. One thing to mention is that Sweden have sales for 1,385, while the US and Central Europe is slightly ranging between 15 and 1,600. So they have a lot of market share to gain, especially based on how strong you can see Sweden is. Their margins are struggling a bit. That is one of the reasons is actually acquisitions, but you can also see their debt is taking up more and more of the statement as financial expenses have more than doubled, even though it still counts as a very small piece of the pie. Some of the newest arrivals are BTC Activewear Limited, which is acquired about a year ago. It is a multi-brand distributor platform that are adding more and more of NVG's brands. The other is Tenson, a high-quality brand known for its jackets. It mostly have history in Sweden, but is slowly branching out as well with New Wave Group's help. They are currently working on penetrating the US market right now, and they are generally well received. The current market is negative, and cyclical products like outdoor, house and leisure does not seem to be lighting up in the immediate future. It looks like they might be a few more quarters with struggle left, and this is what they have struggled with the entire year now. It should be mentioned that with the current interest and with the current inflation, it is a lot more difficult for them to sell these kind of products that is not necessarily needed, but nice to have. They have increased their debt substantially and more than doubled it since 2021. It worries me with this kind of blatant disregard of increased interest, and I hope that they will work on decreasing their debt going forward, even if assets have increased even more. In general, I need to kind of mention that it looks like they have full control of this. It's just seeing a doubling in debt is always scary, at least for me. And then it's the all-time high. As I've been reading through analysis, reports and presentation, one of the things that keep on repeating, new all-time highs. It looks like sales are doing good, but if you go deeper into the products, you can see some of the struggling sides. A mention should be that Central Europe corporate have doubled since 2022 and is carrying the results quite well. And if we disregard this growth, you find that most other areas struggle growing. Here I'm going to go through quick finances, and the first thing I want to mention is that they kind of have a decent growth going on here. So revenue have increased with 58% since 2017, reaching over to 2022. This is a decent increase of revenue growth over this period, and it looks like 2023 will not be as forgiven, so the growth will slow down, but it still have increased in the current market. You can see in 2023 I highlight the Q3 numbers, so it still looks good, but margin have fallen, as you can see. Their result, however, have managed to increase with more than 200%. This is by getting margin control. It is currently still above 10% and controlling cost in a better way than earlier. If they're able to continue the trend of increasing growth and increasing or at least keeping margins, this looks very promising. But if they go back to the margins between 2019 and 2020, the bottom line have quite a lot of risk. So this is the question: if you as an investor want to go in, do you like that risk? Are you willing to take it? After COVID, New Wave Group got good control of their margins and managed, as mentioned, to increase the results by quite a lot. I do think that they can continue to improve this margin going forward, as they seem to be able to continue taking market share and keep the values up during these difficult times. And as always, I need to mention the debt. The debt have increased with the revenue side over side and might soon have doubled since 2017 if the trend continues. I'm not a huge fan of it, but it's kind of something to watch over if it is a trend that will continue, especially if some of their future acquisitions start failing or if their strategy and vision is not really going the way they want. I should be fair to them and say that if they just use the cash inflow they have, they will be able to pay down decent chunks of money, and it's not really a danger at all, but it matters. But at least I wanted to mention it. Their cash flow have been fairly weak. Basically, after a few years with very strong cash flow, the last 2 years have been difficult. But it should be mentioned that one of the key reasons for that is that they have been growing inventory buildup quite substantially. They're just preparing for being able to sell more and more and more, is what it looks like for me. It could be a danger sign that the products are just increasing so much in price, but it do look like this should be related to having actually bigger inventory size. So when it comes to the downsides, with the increased interest, the will to buy new and expensive products, perhaps even the ability to buy the expensive products, have decreased, and most retail industries are currently experiencing hardship in the current day. That is a huge downside, but of course this might look better in the future if we get control of inflation and interest. The increased debt. Their increased debt have considerably increased their interest costs, and as you can see on the result on the bottom line, it's difficult to kind of know how well things will go in the current market, and currently the debt today is extra costly. The current liquidity is currently fairly low. If you compare it to the end of last year, it was almost 200 million SEK lower. If you compare it to Q3, it's not that bad, to be honest, but I like to see the higher number there, especially during the current market. It is in general important to have liquidity, and I do hope the current few months do well, and I look forward to looking at the fourth quarter report to see actually how well or how bad they did there. Though New Wave Group looks strong on paper, if you look deeper in, most of that is from one market alone. This means that most other markets are actually lagging a little bit behind. Hopefully the growth in Central Europe is a sign of what will come in the future in other markets, unless the other markets is actually a sign of what will happen in the future with Central Europe and just a bad trend. So that will be interesting to see. The segments they play around in are not based on must-have, but more close to a choice. So typically NWG will follow market sentiment and do better when consumers and customers have thicker wallets. Their strategy is historically very difficult, and very few companies actually manage to grow throughout different continents. Of course, you have exceptions, you have McDonald's, you have all these kind of things, but it's actually quite difficult. You can just take a very small example. Norwegian companies that are trying to grow in Sweden very often fail, and it's so many examples. Like Europris failed the first time they tried, XXL failed in Austria. It very often happens that they fail. Bringing one way of doing something to another place does not necessarily work in the new country or in the new continent. So it's a little bit more riskier to move your own products, move your own experience out to a different place, but at least it provides some interesting information going forward. So when it comes to the benefits, they do have a lot of experience and learning potential when they try to bring out new and newly bought out acquisitions. And that can create huge potential going down the road. Honestly, if they start getting a handle of how to sell things here, how to sell things there, for example, what is happening in Central Europe right now, this might help them move their huge portfolio of brands over to Central Europe and create higher sales on the different products there as well. This is also creating a diversification, especially in Central Europe where corporate clothing is so big. If they're able to make sports as big as corporate clothing, well, that is more or less, that will help quite a lot with their current results. They are also, of course, receiving a lot of data related to marketing, all the different brands and in all the different places. So they have a lot of experience. They get a lot of benefits doing this. NWG have managed to grow over time, even being able to provide an acceptable dividend. I think this year it has been between 4 and 5%. This is creating at least a safety for me as an investor, and it is actually being paid semi-annually. So you get it twice a year. The current valuation is not adding in any expectations for growth and might be of interest for investors. The question is, will NWG be able to keep up the sales, or do they actually deserve the current valuation? Are they cheap or are they expensive right now? If the current bottom line trend keeps on as it currently is, I would say that they're no longer cheap. But if they're able to continue growing in Central Europe, or perhaps block some of the losses that's happening in other places, the current PE value is actually quite low. Central Europe have since Q3 2022 doubled in sales and is closing in on the earnings Sweden alone holds. This shows what kind of potential value and sales that can happen in New Wave Group if they're able to penetrate the market properly. Like, Central Europe is a lot bigger than Sweden alone, and it is a lot of potential to pick up. Sweden has historically been the biggest income and where they have received the most data. As they try to grow outside, they continue to look for good products in their home base, and they receive a lot of good information on the difficulties in Sweden in general. Sweden is one of the countries that actually struggle quite a lot, lower currency, very high interest growth, and well, in general, they have really received a sour market compared to a lot of other countries, same as in Norway. So where is NWG going forward? Well, it is quite expected that they will continue gaining market share, as both the CEO of NWG and the DNB Analytics are expecting them to continue taking the shares. They're not afraid of the current market, and if all go well, what they do might provide real long-term benefits. The consumers, though, are not happy, and inflation and interest have struck all of the Western Hemisphere. This is making it difficult to move the price over to the customer or consumer, and it will not ease up before inflation is going down, or at least interest is starting to fall. 2023 have not been an easy year, and the bottom line is what is noticing this. The difficulty when challenging prices and growth cycles outside of Central Europe is showing the dangers of the current markets, where almost everything is really going in a downtrend. New all-time highs. Just remember, each new quarter is now possibly a new all-time high, as we have been reading from quarter to quarter when it comes to the top line. So, well, obviously something is going well, and I do hope to see that continuing going forward as well for now. So, as a disclaimer, remember this is not financial advice for anyone to buy or sell New Wave Group, but I do hope that you have got some information about an interesting company, and that you will take the time to actually look in if you are interested, to see what kind of company it is, and to see if it might be something you are willing to or not willing to invest in. Some of my main resources are, of course, the yearly reports, DNB analysis, and quarterly presentation reports. And other than that, cheers!